Welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency market this week and in the weeks ahead. Today I'm joined by Ian Vanderhorn, who is our American-based US FX and rate strategist. There's been a lot of developments in recent days with regards to potential Trump tariffs. But Ian, let's start with the latest first. Trump posted Thursday that tariffs on Canada and Mexico will go ahead on March 4th. This is a departure from his commentary yesterday. What do you make of these very fast-moving changes in terms of guidelines?
Yeah, we have been on a bit of a roller coaster, and I suppose that's par for the course when you think about Trump. But you're absolutely right. The post on Truth Social this morning was a really meaningful departure from what we heard from Trump just yesterday. Trump had his first meeting with his broader cabinet. The media used that opportunity to ask him about tariffs. And he said that tariffs on Canada and Mexico would not go into effect until April 2nd. As we know, April 2nd is more or less that deadline that Trump will have the broader trade reports due on his desk. So it's a real meaningful jumping off point for global tariffs. And Trump seemed to put Canada and Mexico on that deadline yesterday, as opposed to the earlier March 4th deadline that had been talked about, which was really just a deferral from the earlier February 2nd deadline. So his post this morning sort of pushed back against his own comments. He said March 4th was in fact very much in play for a 25% tariff on both Canada and Mexico. But I think it's important to look at the context of his post. The focus was very much on drugs and on the border. He said the rationale for tariffs going back into place was due to essentially a leaky border, drugs coming into America, killing citizens, the usual rhetoric. But why I think this is important is because it's the same exact rationale for the 25% tariffs on Canada and Mexico the first time around, which was early February. And at that point, both Canada and Mexico came to a quote-unquote deal with the U.S. whereby both put troops along their respective borders and promised to clamp down on the border, and therefore Trump delayed the tariffs another 30 days. So I think that's just an important context to put this in, because there's pretty much no guarantee that March 4th will come and tariffs will be put in place, because while it's a very short amount of time until then, it's just a few working days away, Canada and Mexico could both still again come to another deal with Trump. And in fact, both Canadian and Mexican officials have been speaking with their counterparts in Washington throughout the month. So we don't really know the status of any potential deal, but there is the chance that one will come to fruition. I will say, though, that if these tariffs, if Trump decides to move forward with them, they could go into effect nearly immediately, because they would be put through under that IEEPA process, which is an immediate process and does not require a broader trade report to move forward with. So the risk is definitely a lot higher today than it was yesterday, but I would just put a little asterisk around it that there's still no guarantee. And indeed, we think that there's probably, it's a tough call, but probably a slightly better chance than not that these tariffs will still get pushed again to the April 2nd deadline.
And I guess keeping that asterisk in mind, we have already seen a rally in the dollar off the back of these threatened tariffs. Do you expect that to continue into March 4th? And I guess, what does it mean specifically for the Canadian dollar?
Yeah, it's actually been quite a strong move in the dollar this morning. And I think that's, reflective of two main changes in expectations. The first is that you have these tariff-induced inflation expectations. We saw break-even rates here in the U.S. Meaningfully higher off of his post. But also, his comments this morning came, only 15 minutes after a bout of stronger U.S. data. We had better GDP data here in the U.S. So maybe perhaps a bit of a compounding effect whereby the dollar is seeing support from higher inflation expectations that are tariff-induced, but also a little bit of better data. And as we know, the U.S. has been going through a little bit of a string here of weaker economic data. So the reaction in the dollar, in my view, is a bit twofold with respect to that. Thinking specifically about the Canadian dollar, unfortunately, it is really going to come down to whether or not those tariffs are going to be put in place next week on March 4th. I will say this, though, part of the reaction function in markets with respect to tariffs and the Bank of Canada is that the market has been pricing in more Bank of Canada easing when tariff odds have been rising. As in, if tariffs are going to go into place, markets are thinking that the Bank of Canada will ease more and faster. And that's been getting priced into expectations for the March Bank of Canada meeting. But I'm sort of a little bit untrusting of that relationship, if you will. I think the Bank of Canada has been very explicit in their messaging around what tariffs mean for their monetary policy outlook. They've been flagging the risk to Canadian growth from tariffs, but they've also been flagging heavily the risk to inflation. And they've sort of adopted more or less a cautious tone around what their monetary policy reaction function would be. So I think that, yes, the Canadian dollar, the move in dollar CAD will be highly up to what happens on March 4th. But I also think there's scope for CAD to see a little bit of support from the pricing out of monetary policy, essentially rate cuts in Canada into the Bank of Canada's March meeting, just because I don't see that reaction function holding true. And indeed, I don't see the Bank of Canada cutting rates at their March meeting just because of tariffs. Data in Canada has been a lot better recently. We've had sticky inflation, better consumption, and expectations for Canadian GDP tomorrow are on the higher side, actually pointing to a rebound in the fourth quarter. And then I'll just wrap up this thought by saying, well, I think there could be a little bit of near-term support. These tariff threats, whether they come on March or not, in March or not, they will continue to hang over the currency for some time. And I think that's Trump's intention. But yeah, we've talked a lot about North America. So let's switch gears here for a second, because as part of Trump's statement yesterday, he also suggested that there would be a 25% tariff on European autos and other goods. So I just want to know what you think the specific implications of that are on the currencies and regions that you cover, and how did the markets react to this last night and today?
Yeah, I guess, if there's one region which is particularly exposed to potential, auto tariffs on European cars, it is Central and Eastern Europe. And they effectively act as the economic hub, manufacturing hub, feeding into the German car industry. So they're particularly vulnerable. What was interesting was the market reaction, or a lack thereof. They barely moved on, the potential. This is the first time Trump actually put, the figure 25% on European auto tariffs. Was much higher than kind of was expected. And yet you really just saw a lack of reaction from the markets. And I think it's telling that we're continuously seeing that market narrative play out, where there's, maybe some complacency, but some belief that actually Trump's bark is worse than his bite. And I think, if there's one currency in particular that we see, as a real proxy for this narrative or this story about European auto tariffs, it's the Czech crown. So Czech Republic, 25% of its exports are cars. 15% of its workforce are actually directly employed in the auto industry. And there's massive concentration risk, where nearly 60% is actually feeding directly into one German automaker. So I would say that's your way to play, the potential for European auto tariffs. If a deal can be made, and Trump has suggested, an agreement whereby, Europe buys more U.S. LNG or U.S. weapons, and we avert auto tariffs, I think, a lot has already been priced into the Czech crown, and there's a lot of way for it to rally. But I guess let's wrap up on Trump's trade policies, because, trade is obviously not the only thing he is looking at. He's also causing some chaos on the fiscal front. So I know earlier this week the House passed a budget bill that definitely had some implications in the rates and FX side. What did you make of the legislation that got passed?
Yeah, they did pass their budget framework bill, although narrowly. There was just one Republican who voted against it, but really that's all they could have stand to lose given their very, very slim majority in the House. But really, what they passed isn't necessarily um, uh, let's call it a resolute bill. It's more or less a framework around a budget. So, what was in this framework? It called for $4.5 trillion in tax cuts, which really would be the extension of Trump's current Tax Cuts and Jobs Act, which is set to expire at the end of this year. It also called for $2 trillion in spending cuts. A great bulk of that came from cuts to Medicaid and other food assistance programs, which are called SNAP here in the US. And it also, within this bill, called for a $4 trillion increase in the US debt limit. As you may or may not know, we are currently operating under the debt limit right now. So this is something that is expected to be sort of put in with Trump's broader agenda in order to increase that debt limit. So if you sort of just reconcile the tax cuts with the spending cuts, quick math, you'll quickly come out to this is estimated to have probably a $3 trillion impact on the deficit. So the U.S. deficit would be slated to increase by $3 trillion. So that's a meaningful number. And you mentioned impacts to the markets. There really wasn't too much impact on markets yesterday. And I think that's reflective of the fact that while this framework has passed the House, it still needs to move over to the Senate now, where they're probably going to take a red pen to it. They could even tear it up completely and try to move forward with something much different. If we remember, the Senate actually passed their own version of this budget framework last week, last Friday. It was a much smaller bill. All it contained was mostly stuff around the border and military spending. It did not have anything around tax cuts, and it didn't have anything around the debt ceiling. So a much slimmer, call it easier to digest bill, but one that left out a lot of Trump's major pieces of his agenda. So the Senate passed that version. Now they're faced with a House version that has everything. Markets and ourselves are sort of realizing that there's going to be a lot of changes that are going to have to be made before they come to an actual agreement on what the spending framework will be. And I think that's probably part of why we saw a bit of a muted reaction. Senators are going to push back on that $3 trillion increase to the deficit. They're probably going to push back on some of those cuts in Medicaid. And to be honest, the cuts when it comes to taxes, all it is an extension of the Tax Cuts and Jobs Act due to expire this year. It doesn't include any of Trump's other wishes, be it no taxes on tipped income, no taxes on Social Security benefits, those sort of other sweeteners that Trump promised on the campaign trail. It doesn't, include any of those. So, in other words, what the House passed yesterday, it's probably very unlikely to be made into a bill in its current form. With that said, should it go through and should it pass by miracle in its current form, it probably would weigh on treasuries, probably means a stronger US dollar just because of that deficit impact. The Treasury would now need to fund that $3 trillion deficit, albeit over 10 years. They would probably need to start increasing Treasury supply at the end of this year, and that would probably weigh on US Treasuries and could support the US dollar just on the higher rate implication from that. But like I said, more news to come with respect to the budget. This is definitely not its final form, and it will definitely take a little bit of time as the Senate now sort of unpacks the House version, and together they try to move forward with what's very likely to be a different budget framework.
So a lot of uncertainty, but potentially big market impacts. They're definitely tricky markets to trade. Ian, thank you so much for joining me this week. And that's about all we have time for this week's edition of the Currency Exchange. Please do remember to click like and remember to subscribe so you get the latest episode first. Thanks again.